Why is Nikkei 225 rising today? Is the breakout real, or a blow-off top? This video answers those questions with institutional-level reasoning. The Nikkei 225 just printed a new all-time high. The headlines are euphoric. The retail crowd is all in. And yet, underneath this melt-up, a trap is being set that will liquidate late longs with brutal precision. In the next 12 minutes, I'm going to show you the one number, one single price, that separates a 2,000-point rally from a 2,000-point freefall. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. Right now, price is trading at 69,902, up nearly 500 points on the session. The Nikkei is a freight train. The monthly, the weekly, the daily, the 5-hour, the 1-hour, every trend you can measure, screams strong buy. But this is exactly when institutional traders stop chasing and start building exit liquidity. My job here is to show you where the trapdoor sits, and where the one high probability long entry still exists for those who are patient. Here's your instant market verdict. The Nikkei is in a bullish trend until proven otherwise, but we are entering a critical exhaustion zone. Today's bias is by dips above 69,600, but only if price respects the pivot. The moment that changes is if we get a 4-hour close below 69,175. Write this number down. 69,175. That is the pivot point derived from yesterday's range. If the Nikkei closes any 4-hour candle below that level, the entire short-term structure resets, and we are no longer buying dips. We are then watching 68,329 as the first demand zone where buyers must show up. Now let's add the institutional lens. The herd is positioned overwhelmingly long. Futures positioning data shows speculative longs at extreme levels. The yen is the silent killer here. The US dollar to Japanese yen is flirting with intervention territory above 161. Every tick higher in the Nikkei is being fueled by every tick lower in the yen. This correlation is near perfect right now. If the Bank of Japan even whispers about currency support, or if the Ministry of Finance steps in, this Nikkei rally will reverse so fast that stop losses will be gapped through. That is the trap. And that is why the 70,445 level becomes the most important number on the board. Let's go deeper into the technicals, chart by chart, starting from the top. On the weekly time frame, price is parabolic. The 200-week moving average sits somewhere near 40,000. The 20-week moving average is at 58,000. We are trading almost 12,000 points above the 20-week. That is an extreme deviation. In any normal market, that signals a rubber band stretched to its limits. But central bank liquidity can stretch rubber bands further than most traders can stay solvent. So we respect the trend, but we respect the tension. Drop down to the daily chart. The 5-day moving average is at 68,447. The 10-day at 67,513. The 20-day is at 66,244. Price is above every single major daily moving average, and the moving averages are fanning out in perfect bullish alignment. The 200-day moving average is at 55,413. More than 14,000 points below current price. That tells you how far and how fast this market has run. This isn't just a trend. This is a momentum anomaly. And anomalies always correct. The question isn't if, but when, and from what level. Now, the 4-hour chart, this is where the hidden divergence is building, and here's what most traders miss. Price has been making higher highs, but look at the 4-hour MACD histogram. It is beginning to flatten and roll. The MACD signal line is still rising, but the slope is declining. We don't have a confirmed bearish divergence yet, because price hasn't made a new high accompanied by a lower MACD high. But the setup is brewing. If the Nikkei pushes into 70,445 and the 4-hour MACD prints a lower high, that is the textbook negative divergence that precedes a sharp mean reversion. Meanwhile, the daily RSI is at 67.2. Not overbought. Above 70 is overbought, but it's within a whisper. And the stochastic oscillator, on a 9-6 setting, is at 95.998. That is pinned. That is exhaustion. In any other asset, a stochastic above 95 on the daily is a warning klaxon. Here, because of the BOJ bid, it can persist. But the moment the fundamental driver shifts, that stochastic will act like a coiled spring. Let's map the exact support and resistance levels. Support 1 is 68,329. Support 2 is 67,904. Support 3 is 67,059. Resistance 1 was 69,600. We've already sliced through that. Resistance 2 is 70,445. Resistance 3 is 70,871. The pivot is 69,175, which we are currently above. This structure tells me that as long as price holds above the pivot, the path of least resistance is toward resistance 2. But once we tag 70,445, the real battle begins. That level aligns with multiple measured move extensions and the psychological 70,000 handle. It's the level where breakout traders will pile in, and where smart money will look to sell into strength. There's a cross-asset linkage you cannot ignore. Gold is moving tick for tick with real yields collapsing in Japan. The S&P 500 futures are also at record highs, but the VIX is creeping higher, a divergence in equities that often correlates with a Nikkei pause. More critically, the yen carry trade is the engine. As long as the Bank of Japan keeps rates at rock bottom and refuses to taper bond purchases, capital floods out of yen and into equities. But every day that passes without a BOJ move, the probability of a sudden shock increases. The market is pricing in zero chance of a rate hike at the next meeting. That's a crowded consensus. And when consensus is that one-sided, the smallest surprise generates outsized moves. My 1 to 2 week directional lean. The Nikkei grinds higher in a melt-up channel, but the move becomes increasingly fragile. The exact event that invalidates this bullish lean is a daily close below 68,329. If that support fails, the trend is not merely pausing, it's reversing, and 67,000 becomes the magnet. On the upside, a 4-hour close above 70,445 opens the door to 70,871 and potentially a measured move to 71,500. But I would not chase that breakout without a confirmation close. Chasing breakouts at all-time highs in a stochastic saturated market is how accounts get blown up. Here's where I need your input. Do you think the Nikkei hits 71,000 before we see a 5% correction? Comment yes or no right now. I'm tracking the consensus on this channel, and the results next week are going to be extremely revealing. Drop your answer below now, the section most people skip, the actual trade setups. But that's exactly where the money is made. Keep watching, because I'm about to give you 3 fully structured plans with exact entries, stops, targets, and invalidation rules. Every one of these is designed to match a specific risk profile, from the patient sniper to the aggressive countertrend scalper. Strategy 1, the sniper, the conservative play. This is a pullback long, not a breakout chase. I want to see the Nikkei retrace down to the pivot zone near 69,175 and find support. The exact trigger is a 4-hour bullish rejection candle, ideally a hammer or a bullish engulfing, that closes back above 69,200. Entry on that close. Stop loss goes at 68,890. That's just below yesterday's low and the short-term demand zone. Tight. Target 1 is 70,000 round number, where we take partial profits. Target 2 is 70,445, the major resistance. That gives you a risk-reward ratio of roughly 1 to 3.1. The trade is voided entirely if the Nikkei prints a 4-hour close below 69,000. Below there, the pullback is deeper, and the sniper waits for the next demand zone at 68,300. The sniper, conservative, entry. 69,200, 4H close above after pivot bounce, stop loss, 68,890 take profit 1, 70,000 take profit 2, 70 for 45 risk, reward, 1:3.1 are invalidation, void if 4H candle closes below 69,000. Strategy 2, The active trader, the standard approach. This one leans on the momentum but manages risk around the breakout level. Entry condition. A 4-hour close above 70,445, with strong volume. Many will try to front-run the breakout. We wait for confirmation. Stop loss is placed at 69,800, just below the breakout candle's low and the prior resistance turn support. Target 1 is 70,871, the resistance 3 level. Trailing stop rule. Once target 1 is hit, move the stop to the entry level to create a risk-free trade. Target 2 is 71,500, the psychological magnet and a measured move extension. This setup carries a risk-reward of roughly 1 to 1.8 on the initial stop, but the trailing mechanism dramatically improves the reward profile. Invalidation. A false breakout that slams back below 70,000 within the same 4-hour period. That's a trap and you cut immediately. The active trader, standard, entry, 70,445, for H close above, stop loss, 69,800 take profit 1, 70,871 take profit 2, 71,500 risk, reward, 1:1.8R, initial, invalidation. Void if price re-enters below 70,000 on same candle now. Before I give you the aggressive play, I want to see your trading ranges. Type your Nikkei range for tomorrow, high and low, in the comments. Let's see who's aligned with the institutional levels. I'll be pinning the best range tomorrow. Strategy 3, the aggressor, high risk. This is a counter-trend short against the melt-up. Only for those who can lose small and manage risk with surgical precision. The entry is a limit sell at 70,445, exactly at resistance 2. I want to see price tag that level and show signs of rejection on the 15-minute chart, a shooting star, a long upper wick, and an RSI divergence on the lower time frame. Entry is on a 15-minute close below 70,400. Stop loss is tight at 70,750, just above today's high and the resistance 3 zone. Target 1 is 69,600, which is the previous resistance now acting as support. Target 2 is 68,329, the daily support 1. This trade has a risk-reward ratio of roughly 1 to 3.8, but the win rate is much lower. The structure is against the dominant trend, so position size must be tiny. No exceptions. Invalidation. Any 4-hour close above 70,750 and you step aside, the melt-up is real, and you don't fight the freight train. The aggressor, high risk, entry, 70,400, 15-minute close below after 70,445 rejection, stop loss, 70,750 take profit 1, 69,600 take profit 2, 68. 329 risk, reward, 1:3.8R invalidation, void if. For H close above 70,750 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact BOJ announcements or US session liquidity events. Stops are non-negotiable. This is how you survive to trade the next big move. On the Nikkei, the moves are fast and the gaps are wide. Respect that. Now, let's bring it all together. The single most critical level for the next session is 70,445. If the Nikkei breaches that with conviction, the melt-up has one more leg, and we are targeting 71,000. If it rejects and falls back below 69,600, the trap is sprung, and we are looking at a rapid air pocket down to the 68,000 handle. Your plan is now clear. You have the levels. You know the invalidation points. You know where the herd is wrong and where the opportunity sits. Tomorrow's wildcard is the Bank of Japan's meeting minutes and any yen jawboning. If US dollar to Japanese yen snaps back below 160, the Nikkei will feel it instantaneously. I'll be watching that cross-asset link like a hawk, and I'll bring you the updated levels before the open. If you want the full breakdown on Bitcoin and the S&P divergence, because that correlation is breaking in a fascinating way, that video is live now. Tap the end screen, or find it in the description. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. This is Alpha Market Meridian. Trade the levels, not the noise.